Thank you, Groom. Once again, thank you very much. I had a meeting right prior to coming here, so he was delayed for literally about 45 minutes from Wallo Safar to here. So I could imagine the winter drive is a bit messy, but I'm glad you are all here, and I'm very excited to be able to host our dear friend. I think Paul is the friend of Ethiopia and business community in general. So we're very glad to have him. One of our mission at the Orbit sort of ecosystem is not just solving problems applying digital solutions and services, but rather to be able to connect the dots. I mean, that is one of the hardest things in Ethiopia, as everything is fragmented. Information is fragmented. Places are fragmented, but everything is scattered. So connecting the dots is something that will make our collective life better. And then today, I think that's one of our mission, or what we're trying to accomplish. I've known Paul for a while within the community, but particularly in the professional community, the type of work he's been doing from investment banking to other areas. I think without saying a lot, let me just open up the floor and Paul, tell us, who's Paul? What do you do? What have you done? And Groom sort of set the tone saying that 32 years of experience actually probably goes beyond that. But just to shine a light into your journey of where did your career started, what have you done, and what are you doing now?
Sure. So 32 years seems like a very short amount of time, to be honest. I feel like it's 7 years in reality. So I'm at best in my late 20s. That's how I feel. But I started off, I was born in Germany. I lived in Nigeria for a long time until I sort of became sort of conscious of life, and then moved around with my parents to different places in Africa and the Middle East and Asia. I graduated as a chemist in 1989 and promptly never looked at chemistry ever again. I almost joined the army, the UK British Army, but fortunately everyone advised me that that would be a dumb idea at the time, and I didn't. So I became an investment banker working in London until approximately 1996. And then I was very fortunate to work for a bank called Baring Brothers that went spectacularly bust and consequently got bought by a large European bank called ING. And ING buying Barings, although it felt terrible at the time, was the best thing that happened to me because I got to join a really large financial services organization, insurance and banking, 92 countries around the world, 150,000 employees, very complex business. And with that organization, I actually learned a lot more about how the financial services sector worked generally, and how banking really worked specifically. And then in the sort of early noughties, it was time to go back to real client-related work in merchant banks and investment banks. So I joined a firm called Rothschild, which is a global investment bank, operates in 40 countries around the world. And for them, I started some businesses in Western Europe, Middle East, and India, Dubai and India, and also subsequently then in Scandinavia and the Benelux. So by about 2016, 17, I was approaching 50, let's say, and I'd already worked for a little while whilst based in the Middle East for the government of Ethiopia between 2010 and 2012. So by that stage, I'd come across this amazing place, which I knew nothing about prior to that, called Ethiopia. So I did a lot of work for those 2 years here, and I was traveling on and off here, and really until 2016, when Allah being merciful and God being great, I managed to find a job here with Mawenco, which is a British-owned company. I worked there for a few years, building the business in East Africa, outside of Ethiopia, and also trying to figure out what the hell to do with a mountain of trapped burr. And it was that experience which really led me deep into the investment ecosystem in Ethiopia and around East Africa, and particularly into the early stage ecosystem in Ethiopia and East Africa. And a couple of years ago, I joined a firm called Renew, which is an impact investment firm that does a couple of things. One is building capacity, donor-funded, and the other is investing with commercial money. And obviously, these two things work great together, reducing the cost and risks of investing, at the same time building capacity across a number of East African countries, now Ethiopia, Uganda, Rwanda, Tanzania, Zambia, and Kenya. So that's the sort of short story. Who I am, I guess, I'm a financier, broadly speaking. I don't have any sort of particular sectoral or product preferences. I've done a lot of different things in a lot of different places over the years. But now my interests really lie in investing in early stage businesses, small and medium-sized enterprises, because that's really where, particularly in this region, where bang for buck, you create the most jobs and the greatest change and impact. Does that make sense?
That is astounding. I think there are so many questions I'd like to ask, a little bit unpacking your past experience. To begin with, the difference between investment banking versus merchant banking. Do we even have one in Ethiopia when it comes to IB, investment banking?
Yeah, I mean, that distinction could be debated anywhere on the planet. But here in Ethiopia, I think we're just at the start of that journey, right? So I spend a little bit of my spare time with the Ministry of Finance, Central Bank, NBE, and those trying to sort of develop the capital markets generally, not just the private equity part of the capital markets, but the public capital market. So the distinction between an investment bank and a merchant bank, if you read, for example, the Capital Markets Proclamation, it's not very helpful to understand how the rest of the world thinks, what the rest of the world thinks an investment bank is. A merchant bank uses its own money and its brains to make more money for itself and its shareholders and other stakeholders in the business it invests in. An investment bank really just gives advice in its purest definition, but also there's a whole bunch of other products and services that lie around it. So market making, fund management, asset management, those sorts of things. And we have none of those really. We have no domestic fund management business, like asset management business, and we have no domestic investment banks. There's a couple of representatives in the room of what will become investment banks in due course, but at the moment I think we're just starting. We have some pretty close approximations, but they're really just corporate finance advisory businesses.
So in the light of sort of global mobility of investment, for example, Ethiopia has been trying to sort of open up doors for global investors to come in. Now, which means automatically we also need to develop.
Not leaving, but
Sure. Not leaving.
It's
not a tough question.
I'm not going to like that question.
So such institutions in capability should exist to attract global investors or to be able to play in this global finance space. The existing banks actually, in fact, the conversation that's just having, they really don't have a need to look for outside money. I said, why? They get money from shareholders and what have you. They only lend the money to the top. In fact, the number is scary to me. Almost less than 50,000 individuals or companies are the only borrowers of
Actually borrowing. Yeah.
Actually borrowing. Outside of out of 110, 20 million people, they're only willing to lend money for this pool of 50,000 individuals and businesses. Now, partly it's a lack of confidence and lack of capability, what have you. So in the light of that, where do you think we are in that journey, joining the global sort of finance space, but at the same time, what kind of hope do we aspire to really steer the economy from within, instead of just looking for outside money to come actually infuse the entire economy?
Yeah, I mean, time is deceptive anyway, right? So if you think about the history of the world, we are in the last sort of few seconds before 12 o'clock, if you think about it in terms of a 12-hour dial. But even so, the time over which mankind has been operating and evolving, we feel is a very long time, understandably, in the context of our lifetimes. So if you think about the time frame within which any economy develops, it's generational, it's not overnight. So I think there's a lot of sort of time and energy spent sort of criticizing where we are, but it's not necessarily particularly helpful as long as we know where we're going. So if you think about the approach of Marxist-Leninists to the private sector and capital markets and banking systems, it was very negative. In the end, it's really the government wants to control all aspects of the economy, including the banking system, and that's fine. And private sector sort of energy is discouraged. So you end up, and if you then overlay that with the regulation that sort of allows that to be controlled, you end up with a system, a banking system in Ethiopia, which is, frankly, was never fit for purpose. It was never really fit for purpose. It served the interests of shareholders and depositors, perhaps to some extent. But the banking sector in many markets is designed to fuel the economy. And here, as you say, it fuels a fraction of the economy. But if you think about how much has changed, even in the last 4 or 5 years, so the number of banks, the perception of private sector, the perception of the banking market, discussion about banking market liberalisation, capital markets development, which is all critical and intrinsic to the kind of changes you're talking about. But to be honest, I still don't think we've resolved in Ethiopia whether we want to be connected to the global system or not. We still haven't resolved in Ethiopia whether we are actually a little bit socialist about life and whether the private sector is a good thing and a liberalised banking sector. You never get a fully liberalised banking sector, by the way, right? So whatever your expectations might be, the banking sector is always really controlled by the state, wherever you operate. It may not look like it, but ultimately the method of regulation means that the behaviour of bankers, and therefore what banks provide, services and product-wise, how big their franchise become and how much of a utility they really become to the economy is controlled by most governments. There are very few examples where actually the banking sector is generally fully liberalised, quite rightly. So we have to resolve a number of things in Ethiopia still. When you still have the debate, I mean, I had sort of a sort of family, I think it was this last Gena, and we were sitting around, and my sister-in-law's brothers and all the guys, the brothers and the brother-in-laws, essentially, sitting in a long row, grilling me about why liberalisation made sense. Of the 7 of them, only four were sort of even vaguely sort of sympathetic to the idea. 3 were absolutely clear it wasn't necessary in Ethiopia, and some of these guys were bankers.
To liberalise.
Is it necessary?
Yeah. Is it necessary?
So there's a bunch of debates, and that's before you come to the discussion about whether or not the government's really committed to liberalisation generally, right? So, I mean, clearly the messaging's reasonably clear. Many of us in this room see the changes underlying, sort of discussions about policy change, regulation change, the project groups that are working on all these things. But in the end, whether the conviction is full, we'll find out over time. Yeah. But compared to 4 or 5 years ago, it was inconceivable 5 years ago that these kind of conversations we would be having.
Yeah. In fact, some of these discussions that we are having with some of the ministers, they wanted to drive the banks actually to take more risk to engage in developing the economy, particularly if the venture aspires to bring plenty of employment. So there is some approach that they're contemplating. They could do that because
sure. My blood runs cold when you hear me tell me that a government employee wants banks to take more risk. Right? It's up to the banks to decide what kind of risk they take. The problem is we don't really have a sensible regulatory environment. The tools of regulation are very blunt, and still there's a huge hangover from sort of the previous government's objectives in terms of, quite rightly, financial inclusion. But there are much more intelligent ways of regulating banks and balancing risk and return, and therefore allowing them to decide on their own for their shareholders' purposes where the real opportunities are for them as a financial institution. But of course, everyone pretty well at the moment is told what they can do, and doing anything different is difficult. And then, of course, you've got to layer in the ability to visualize a different product and service environment. And if you have a very insular domestic market, then you don't have a lot of bankers in Ethiopia who understand what it's going to look like in 10 years' time. And it's scary because there's a whole bunch of control that the current regulatory environment has to release. So there's a whole bunch of new control that they have to learn how to operate, if that's what they want.
So in the light of EMEA, you have a lengthy sort of years of experience in this capital market finance and investment banking in general, when you look into the trend, where it is at now and what it used to be, and is there any model that we can sort of not 100% copy but emulate and then sort of aspire? Maybe Ethiopia might fit into this trend, or it's completely unique. This is kind of, we all try to allude that, but ultimately we could not be an island. I mean, the global market, whether we like it or not, one way or another, we're affected by it, or we're contributing towards it, whether we do it intentionally or as a byproduct of what happens globally. So, but I'm kind of curious to see, sort of picking from your past experience in that region, is there any market that you can say potentially this is something that would look like closely?
You're talking about capital markets in particular, or generally?
In general, the whole capital market, finance, and in the investment banking space. Because all of them vary. I think I really like how you put it. Sometimes it's so easy to criticize where we are at now because we really aspire to see lots of things to change radically and rapidly. But I think we came a long way, even in the company as an orbit. We've seen we were kicked off at some point. We were told like there's no standard, so we're like, okay, how can we help? Okay, can we help you come up with a standard? There's no policy, there's no governance. Well, instead of saying, oh, the government is saying there's no standard, but rather, how can we contribute? Now there's a standard in the medical record space or the digital health space and what have you. Just a tiny bit of change that we've seen has made tremendous amount of sort of impact. So within the EMEA sort of context.
Yeah, I mean, so just being sort of trying to be super positive for the start. If you think about what we've achieved as a country over the last sort of 15 years, during a lot of which time it was definitely not a private sector friendly environment, but that you still feel the energy, you still feel the growth, you still feel the activity. And so the way I think about it is if you just take your foot off the brakes just slightly, then imagine what can happen in terms of real change and then impact. But in terms of looking at models, I think the best models really to sort of think about are those that came from not necessarily sort of a socialist regime, but a very controlling environment. And so if you look at, I don't know, China as a case, Vietnam as a case, but Malaysia, Thailand, all the Asian tigers, countries of Chile, Brazil, not Argentina, that's a very bad example. I would argue unless there are any Argentinians here, in which case I'll change it. But I mean, essentially, there was a whole bunch of quite technical policy changes during the course of the sort of 90s. And I was working in Asia in the 90s. So there were a whole bunch of policy changes made at a government level, which would enable the private sector to thrive. The primary drivers of all of that were the financial services sector activities, and within that, investment into the country. So everything that could possibly be done to mobilize capital was done. And we're experiencing some of those things now, right? So we're seeing changes in the investment laws, we're seeing sort of startup proclamations, and reducing minimum capital requirements and all that kind of things. But on that dimension, we could go a lot further, given the lessons that everybody else has learned over the last 40 years, essentially. But for some reason, we go more slowly. And then the other sort of main change, I think, is that the conviction of the government, both across it and down through it, was absolute. I mean, there was a complete buy-in to the proposition that the private sector would do the work, which means you see changes at education level. I mean, the education of people, and so all of a sudden, people were talking about building a generation of people who were job creators and problem solvers. They were innovative. They weren't being groomed to be job seekers, which semantically sounds really easy to say, but practically is very difficult to do. But it's a complete mentality shift. At the same time, the regulatory environment against which the private sector was bumping up, particularly in sort of places like Indonesia, Malaysia, and Thailand, was completely dismantled. They didn't sort of they didn't improve it by degrees. They literally just cut it all out and put a new framework in. And so that's very painful, it's very sort of concerning, what's going to happen to tax revenue, what's going to happen to control and regulation. But it doesn't take long for that all to sort of be ancient history already. And again, here we have that sort of dichotomy where the government clearly understands the need for the private sector to do all the work and generate taxable revenue so they can then spend it on infrastructure and things. But there appears to be a reluctance to really just burn it to the ground and start again. And it comes back to the question about conviction, it comes back to the question about what kind of Ethiopia do we want, and is it, how different is it from the Ethiopia we want now?
But also you're also risking the Asian market collapse, the crash.
Sure.
It happened. I'm not sure whether the contributing factors were partly the total liberalization of the entire economy, or I'm not sure where is the fine balance. It's like a pendulum.
But have you ever looked back at a share price graph and tried to find the Asian crisis? It's very difficult to find. I mean, if you look at share price over time. And sure, it was, I completely agree that there were a number of things with hindsight that one might have done differently, but those kind of things would have inhibited the change that happened, the fundamental change that happened. There are crashes all the time.
Yeah.
There's exuberance all the time, not just in developing economies, but in so-called developed economies. When money is cheap, when borrowing is easy, then that kind of stuff happens. Yeah. So I wouldn't necessarily blame the Asian tigers themselves for that. On the contrary, I would say, this is one of the features, one of the negative features of the global financial system, which is money goes to where money sees the greatest return on whatever its sort of comparable is, benchmark is. So, but yes, I think the role of the regulator and the government then is to say, well, how do we balance these things? But I think most people would understand that there's a shed load of opportunity cost sort of over the horizon. All these changes that one might talk about, we haven't talked about the big one yet. Yeah. All these changes that one sees, it creates a lot of short-term pain. But there are a lot of people, if we don't change that, then there's a lot more people in a lot more pain for a lot longer time. So, and then the other point I would make is that the people who are going to hurt the most are the people who have vested interests in the current system and who've been exploiting it unfairly for a reasonably long period of time. So, what's the problem with that kind of sort of profound change and profound crisis? It happens all the time. It's true, though, here, in many jurisdictions, even by that stage, the banking system had evolved very rapidly. So the transmission mechanisms existed. So between the government, between the private sector, and the government, the public sector, the private sector, and foreign investors, there was a reasonably efficient mechanism for transferring risk and opportunity around. So when the outlook changed, capital could move to the right place, because obviously it looks like a drama, but it's a future opportunity. So capital moves to the right place and starts creating opportunity, jobs, and fixed asset base in different places. And that's all a financial crisis really is. It's a realization that money's in the wrong place. And the ability, an economy's capacity to have those crises is actually healthy.